Hello, thank you for joining me on the Compassionate Capitalist podcast and video if you're watching on YouTube. Today, I'm going to cover some of the inside secrets that are in part of the 44 Inside Secrets to Angel Investing. This is the book I wrote a couple of years ago in response to the great democratization of the capital markets. If you recall, well, I also used it as a start for the compassionate capitalist movement. But if you recall, back in 2010, when we were trying to pull ourselves out of the Great Recession, our government passed bipartisanly the Jobs Act. And most people think of that as primarily in order to give entrepreneurs an easier way to get the capital they needed to start and grow their businesses, because in our digital age, why shouldn't they be able to reach out to potential investors the same way that they reach out to customers? And it was intended to, Jobs Act, to create jobs, jumpstart our small businesses. And but the thing that most people don't really think about on that, at the same time that was happening, where we were having a real struggle for businesses to get bank loans and to get access to capital. Most of the angel groups that existed at that time in 2012, 13, 14 were very tight, exclusive types of organizations and networks that focus their investing on primarily on certain sectors, technology or biomed. And they focus a lot on geographic, what was around them in their state or in their city, because they wanted to they're dealing directly with pure startups that are unproven, and they wanted to be able to monitor them, to help them, to give them the resources besides the capital that they needed. And I had started back then, I had used the term compassionate capitalist for a while, and I renamed my podcast the Compassionate Capitalist Show from Southeast Private Equity Conference Spec Talk Radio, because I really saw in my own angel group at the time a lack of investors recognizing the impact that their dollars could have on the local economy by investing and uplifting these companies. And I wanted to be able to expand that out and create the concept that says we can really impact and influence our economies and our communities and the wealth in our communities if we lift these businesses up and give them access to capital that they can't yet qualify from a bank, or they need more capital than a bank would provide, and they don't yet qualify for venture capital, or as they get to that point that they could qualify for venture capital, they've proven it out, they've got customers and revenues, they've got a pipeline of millions of dollars coming, they would be able to get access to capital. And if they don't qualify for VC because they're in the wrong sector for a lot of different reasons, there's a lot more money that goes into companies at an angel investor stage than there is at a venture capital stage. And those companies don't qualify. Even a company that's 3 or 4 million in revenue that maybe had an early round of capital from angel investors in a group don't get. They didn't qualify for VC. They missed the boat on that. They're not yet big enough for private equity funds if they want to bring out a whole nother product or a product line, or expand into a different sector or into a different industry, or expand from their state into other states. It's really a struggle for them to get capital from the primary sources. Those angel groups, they may be the wrong industry or wrong location or wrong stage. VC, same reason, same thing. They chose a different company, but doesn't mean that company can't be successful and produce a return on investment. And banks and the private equity funds. So the good news about the Jobs Act was that it allowed these different ways. The 5 ways, I've talked about it a lot, of crowdfunding, which is your intrastate in your state, Reg CF, as well as 506C, Reg D 506C, and Reg A Plus are all ways to sell equity in a company to the masses, okay? Direct public offering to people. They have their own levels of restrictions and setups and things that you have to be aware of. But the big thing, and the reason why I wrote this book, what we call the great democratization of the capital markets, is that at that time, our government under President Obama recognized that a lot of people had lost their retirement. They had lost their nest egg because of the collapse of the real estate market and the collapse of the stock market at the time, because of the shenanigans that some of our biggest financial houses were up to, which I've done another thing on that. It was a whole nother history as to why that happened. But this was an opportunity, because if you look at the returns on investment for people that invest in entrepreneurs, right, compared to real estate and stock as your big major other asset classes that have a little bit of a speculation to them, that the average return on investment for somebody who invests in entrepreneurs is 3 times what it is for real estate and stock market. And I've done the analysis. I do this in an educational presentation I do, or pitch, or when I'm called into economic groups or Chamber of Commerce's to present about economic issues and angel investing, compassionate capitalism, the compassionate capitalist movement, my movement, it took 10 years for the stock market to get back to the baseline of where it was when it dropped in 2010-ish timeframe. Same thing with real estate. Now it's got a whole nother thing that's happening now, but during that time, people that invested in angel companies, those companies that went on to become successful, to be acquired, most of them get acquired, they don't IPO, they made a return on investment. And so my biggest fear, because I knew that the Jobs Act was necessary for these entrepreneurs, but there would be a lot of people that were not as experienced as the angels that are a part of these very, very contained and exclusive types of angel groups, that they would make an investment based off of emotion or really cool video or something, without looking into what really needed to be in place for that company to be successful, to produce that return on investment. So I took the 10 years of working with angel investors, all of the hundreds of conversations and interviews that I've had with investors about how they got started, how they made their decisions about making investments, why they invested in this company or not that company, all of that I put into this book, Inside Secrets. And then as I was writing it and going through the process, there's a step-by-step guide in every chapter of your next steps of what to do to equip yourself to decide, should you, would you, could you be an investor and entrepreneur. It's the greatest source of wealth in the world, but unless for royalty or something like that, but the greatest source of wealth comes from a successful entrepreneur. Being a successful entrepreneur creates potential generational wealth, as well as comfort and wealth for that lifetime, whatever. That's a way a lot of, and the next greatest one is by being an investor in that company, whether it's a small silent partner, or whether you're, a big super angel. I describe all of that in the book. And, I borrow a lot from the cash flow quadrant. Sharon Lechter wrote the book, Cash Flow Quadrant, and after Rich Dad, Poor Dad, and talked about being on the right side of the quadrant, which is business ownership to create wealth, that your money works for you, but then also putting that money to work in other entrepreneurs as an investor, that those entrepreneurs are working with your money to produce a return, to produce profit, to produce a result. So with that explanation, I'm going to start this series of going through some of these of the 44 inside secrets that are in there. They're little nuggets, golden nuggets. Number one secret, the first secret in Inside Secrets to Angel Investing, is most angel investors who are in the business of investing anticipate some of their investments will fail. They mitigate risk through garnering information about the company and the market. They make a commitment to invest in multiple companies over time and to build a diverse portfolio, yet they also only invest what they can afford to lose. So to somebody like myself that's been around this all along, and people that have been around angel investing a while, that's all very common sense. Okay. But for those that aren't, because I found that a lot of the folks that could be angel investors, there's about 5 million people in America that make over $250,000 a year on their paychecks or W-2 statements that could be easily be angel investors. They just allocate the amount. So one of the things, so let's break this down. Yes, there will be investments that fail. There's an old adage that you might have heard if you've been looking into any of this, and that is that there's VCs say you invest in 10 companies and 3 are going to fail completely, 3 are going to do okay, 3 will do pretty good, and then one's going to make up for all the rest to give your big portfolio return. And if VCs have all the resources and the money to figure out the right ones and they can't, then that just tells you that it's really difficult for individuals. Now, I know a lot of individuals that have been highly successful because they're very discretionary in their investments. Sometimes, you know, VCs try to get ahead of trends and anticipate the big unicorns, which is sort of a myth in a way. Yeah, there are some companies that get to $1 billion in valuation, but a lot of times it's because of all the money that's been put into them, not necessarily because of what a traditional stock market investor would consider is the market cap of that company, because they may only be doing 50 million in revenue. So how are they $1 billion company, right? And so that's a completely different space than who I'm talking to you right now as a potential angel investor. So the first step that you have to do in this is understand that. So you never want to invest. This is not speculative like doing day trading or anything like that, because your money's going to be tied up for a while. There's lots of different ways to get started in investing, just like there is with real estate investing. And you want to target the ones that are going to produce a quick return, because you're bridge financing to something, you're building your nest egg, versus the ones that are a long-term return that's going to take them 5-8 years to get to an exit. And then for those of you that don't want the risk of a pure startup, then you're going to want to look at companies that are in a growth stage that might be under a Reg A plus kind of a thing, because they've got millions in revenue and they're seeking to become, 10x that. Right? And then they can get bought by a hedge fund or private equity fund or a big corporation. And they may not get to a point of being big enough to be an IPO, which has got its own level set of stuff that happens with IPOs. So that's the first thing, right? So anticipating that, so you don't invest more than what you can lose, right? Never take money out on your house. Never use debt for doing this. Never take all of the money that you got in some swoop to put into one company. That's why you diversify. And so if you've got, let's say you're an executive that has a bonus every year that's anywhere from $20,000 to $50,000, or you have a big portfolio of stock and you want to sell some of that stock, or you have a big fat 401k that's got $1 million in it, you want to take 250,000 out of that and put it into a self-directed IRA or a Roth IRA or whatever's appropriate for your situation, so that you can direct it into these companies and the returns on those come back, particularly if you're doing royalty financing or revenue financing, where you get a percentage of the revenue paid until an agreed to amount is paid back as a multiple of your money. Those are probably the safest and the easiest way to make a steady return on it. So you kind of diversify your portfolio and all of that. And then as companies move out and you make money, then you put money into other companies, right? You want to invest in what you know. You want to invest in different stages. I have some investors that look to organizations that post those companies that are about to go public, because employees that have been given stock options, and even some early investors in that have large holdings in that will go ahead and sell some of their stock prior to the IPO. So they're selling it at a price that's near your return's not going to be as great, but you do have an opportunity to kind of invest in a sure thing. And so that's a big, those are some of the philosophies that are associated with that. But then the garnering of information about the company and the market, that's your due diligence. I got a whole book, a whole chapter on that. And there's tools in the resource portal that you get when you buy the book that has a due diligence checklist. It has questions to ask your entrepreneurs when you're talking to them. Can they answer these questions? You want to really understand the dynamics of what it is that they're trying to accomplish, and do they know their stuff? Do they know how much it's going to cost them? Do they know how much the cost of sales is going to be, how much the cost of goods is going to be, how much resources they need to grow it? When will they start making enough cash that they don't have to burn the money that they get from investors? You know, all of those things on their financials, have they really thought through that? And if you don't have the time to do that, or you don't have the knowledge necessary, you feel uncertain about your knowledge because you're new about it, well, you know, that's what we do. That's what my organization does for investors, is to help them navigate that and decide which ones to narrow it down. And then, you know, quite frankly, a lot of times the very final decision when you choose between A and B is an emotional decision. But both of those choices should be choices that are existing, you know, that you're good with both of them. They checked all the boxes, so you have mitigated your risk. If you haven't yet listened to it, the podcast from last week was about transparency and the obligation that investors have to ask questions, because there is not much of an obligation on the entrepreneur side to disclose. Right? They can get in trouble if they don't disclose material facts. But when it comes to other things, you really have to ask for it. Now, the good ones will want to give you everything, because particularly, here's one of the things I advise investors on, is that if you're going to invest in a crowdfunding company, whether it's Reg CF, Interstate, 506C, Reg D 506C, or Reg A plus, then you should be able to get to documents that they are made available to you after you sign your non-disclosure and your, you know, certification or whatever level of investment that you will be in a position to make, right? That they don't want to disclose this just to anybody, this stuff, but you should have the kind of documents that you're accustomed to seeing for public companies. You should have full financials. Depending on their stage, they may be audited financials. They're Reg A plus, they're audited financials, just like a public company. They should have, you know, industry reports that say the marketplace, they validated it. They might have done a valuation on it, right? There's organizations out there that will do a really fairly inexpensive valuation of the company based on the intellectual property, based on their marketplace, based on the competition. They should have my clients, if I'm helping them connect up and do investor acquisition, I tell them they got to have a legal opinion that they are sound on their contracts with their employees, on their intellectual property and how they've protected that. How did they get their application developed? Do they own all the rights of that? Have they not had any kind of sexual harassment suits or racial discrimination suits or complaints, right? All of that stuff should be validated by a lawyer, because that's the kind of thing that if it comes out a year or 2 years later could derail the deal, and then you lose your investment. You know, I don't know what the statistics are on which companies go out of business because of malfeasance versus just, you know, market circumstances, but there's probably a good chunk of them that go out, you know, or depending on who's leading the investment, you have to know who's on their board of advisors, who's going to step in if something goes south. You know, one way to be involved in this stuff that I talk about in the book is, if you don't want to do direct investments yet, then you invest in somebody that's a fund or it's taking a lead, and then they're responsible for it. There was a fund that I love, I talk about it in the book, and I found out that one of their key people had stepped aside to go be the CFO in this company because they found out they had not been doing their books right, and they were really bad accounting practices. And I might not have even paid. This is one that sometimes you have to ask, because the entrepreneurs won't disclose it necessarily unless you ask, and it's bad when they don't. When I find out, I'm like, you have got to inform everybody. I saw something the other day. Everything can be handled as long as you know about it. Right? Everything can have a box put around it and be fixed if the fundamentals of the company is good, as long as you know about it. You need their cap table. Is their cap table messed up? Have they been selling it at all different kinds of prices and they got a really messed up cap table? Well, it can be fixed. It takes money. It takes some time. It takes some pain because you got to work with all the existing investors, but everything can be fixed if you know about it. And it's not a surprise later on when the company is at a point that they can't fix it. So that's number one. And I hope that you'll go get the book. You can go to Amazon and get it. Go to angelinvestorsinsidesecrets.com, right? Or the tab on my page. You can even have this book, this right here that I'll be going through. It's 12 of the 44 that I think are like the most important ones. And so I'm going to roll through those and put these in as I'm waiting for guests to get queued up and their shows to get produced and be back to that. So this is the end of one. Thank you for tuning in and listening. Next will be number 6. Onwards and upwards. Please visit KarenRands.co, and thank you very much. Hopefully you found this beneficial to your time and your ears.